Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
Today, the guys and I are going to talk about home equity and lower rates. Is this a match made in heaven or not? There seem to be a lot of opinions about this because you do have tons of home equity and you do have lower rates. They're not the lowest rates, but they are lower rates. And there's still more of that to come, I think, in the future. So we're going to go into that today and immediately pick up mortgage refinancing.
Yeah.
We've been seeing this here, and at large, this is happening. Mortgage refinancing surged 35% in 1 week as interest rates hit their lowest level in a year. This is from CNBC, guys. We were at the front row of this when this happened. The 30-year average fixed rate for mortgages went down, and we saw a huge increase of applications that like week to week and also year over year from last year. So let's talk about it. What's going on?
People are paying attention for sure. As soon as they heard the Fed just announce that they're going to reduce the interest rates, the market took effect, right? Even though the rates didn't officially, the Fed didn't reduce the rate, but just because he spoke maybe about it, like, hey, there's a possibility for September. There's a buzz. There was a buzz.
Yeah.
People started calling, and we did see the market improve, and it felt really good to actually see lower rates. That something we haven't seen all year.
Yeah,
so it was great.
There's
to
a lot
see
of
that.
carryover from those statements that Jerome Powell made into the market, and then some general jitters when it came to labor and jobs, and then inflation, and so. But it's kind of like this, like tug of war a little bit too, because there's a little sense that inflation's maybe done like, accelerating, but at the same time it's like, well, the data has to prove that. But the market reacted like, oh, we're already going into the fall in a lower rate rate environment than we're in. And we saw that directly reflect mortgage rates right away.
No, big time. And it was a good relief. It was like a huge, like, okay, we're starting to see the light at the end of the tunnel, right, Brian? I mean, for us, it's just been crazy to see these high rates lasting so long. Because, I mean, you got in the industry
2017,
right? I was in 2006 when we got in the industry, and I don't remember seeing the rates this high for such amount of time. Normally it was like maybe 8 months, a year, and then next thing you know, they start going down, and then they went up again, and they go like this time around. This is in my experience and being in this industry, this is the longest I've seen it stay up there.
Yeah, they've been sticking.
It's funny because in 2017, 2018, when I wrote my first note, the rate that I quoted and locked was 5.250. And that was like, whoa, I haven't even seen those in forever. I'm like, well, this is my first loan, so I don't know.
Yeah.
But since then, I mean, right now we're literally at that, that range, depending on where your credit's at, high fives, maybe low sixes. But I think it's just been, a lot of pressure these last couple of weeks that, the 10-year has been coming down. So hopefully that sticks and we can continue to get better pricing. Some of the things that I do realize when I talk to consumers or to clients is that whenever they hear, oh, the Fed's dropping the rates, automatically they think that, hey, they're going to come drop 1-2%, but sometimes it's just better pricing, meaning that if you're going to get the lowest of the lowest rate, it's going to be maybe a little bit cheaper than if it was not. And those are something that I think you get confused a little bit.
Well, and people are taking advantage of this in the market. I mean, just from the numbers perspective, quoting the article here, the refinance share of mortgage activity increased to 48% of applications, up from 41 in the previous week. So that's the that's kind of part number one. Yeah. Part number two, check this out, and this is wild to me. Refinances were up 118% compared with the same week 1 year prior. Yeah. So year over year. Now 2 weeks ago on the show, we were talking about how it was up 59% year over year based on that week. Damn. And now it's up 118%. So what you see here is like this initial impact. People go, oh, shoot, the gate open, I'm rushing the door.
Yeah.
But then you also see now the second week into it, we go, oh, people are still like, they're not laggards necessarily, but they didn't get in the first week, but they showed up on the second week in large numbers.
Yeah, because the first week, the rates we totally saw a huge impact on that. It was really nice. Everything looked really good. And then the second week, well, we started kind of losing that momentum. Rates started increasing.
And I want to make this special point because I know you guys are dealing with a lot of this, with people directly. But I know, in internet land and on YouTube, it's especially easy to come to the conclusion that, well, people shouldn't be refinancing right now. Why on earth would you be refinancing? And we've been talking time and time again where there are people who are in situations, whether it's by their own hand or by circumstances that surround them, they just need to. Yeah. And they need some sort of financial relief, and they might even have a really low first that they just can't hold on to anymore. So whether we like it or not, or you like it or not, people are in situations and they need help and their house is coming to the rescue.
But here it is, Andy. Let me just tell you this. We're doing a $1.4 million here in San Diego. The savings that we're doing for this veteran is $1,200 a month. What can you do with $1,200?
$1.4 million?
On $1.4 million, we're dropping it by almost a full percent.
The interest rate,
and it's $1,210 a month. Less.
Dang.
The other great thing about it with VA, obviously, when you pay your payment, it's in arrears. Mm-hmm. So, and then we calculate the prepaid interest into their closing costs. So therefore, it looks like you skip 2 months.
Yeah.
Right.
Yeah.
So when your payment's $11,000 and change, or actually $12,000 and change, you get to put in your pocket at least those $24,000 to go do some type of home improvement, anything like that. Then the other good thing about that is he also has a $14,000 in his escrow account where his property taxes and everything's paid right there. He gets that back.
That's refunded, yeah.
So that's like a mini cash out refinance to help you pay some of those credit cards that have a higher interest rate. In addition to that, you save $1,210. That's just crazy. I'm sorry to say.
So it's a $1.4 million loan. Is this a VA IRRRL?
Yes, it's a VA
IRRRL. So this isn't a cash out situation. We're not paying off debt. This is strictly the VA IRRRL.
That's correct.
Dang, that's nuts.
Yeah. Exactly. The clients were super happy.
Well, yeah,
right?
$1,200 a month goes a long way.
I have another one. It's around. Oh my God! It's like it's in Tennessee, and it's 830, and they're saving about $700.
Wow. That's substantial.
Of course. So it makes sense, Andy. In some of these cases, if your loan amount's $200, $300, $400, maybe $1,000, it may not make the best sense, but when you're talking about larger loan amounts nowadays, it's going to make a big
Well, okay. And we should talk about this too, though, because I think some of these ones you're talking about, these are people that purchased in the last 24 months, right?
12 months.
12 months. Okay. So 12 or 24 months. The point in saying that is the argument sometimes we hear is like, well, why would someone refinance and reset a 30-year term? Well, they're only 12 months into it, or maybe 24 months. Yeah. And so not only did they buy in the last 24 months, they also bought at that price 24 months ago and at the interest rate in that market environment back then. Now that it's dipped down, I did not know that you had that 1.4 with $1,200 savings a month.
Oh yeah,
and that other one with $830 with $700 a month.
We have several of them.
That's
it just
crazy.
Makes perfect sense. And then here's the other thing: we give them a mortgage accelerator calculator that if they apply the same what they're saving, the $400 or $500 back to the principal, we give them right there that they'll pay off their house in 6 years less than the 30 years. So we already caught them up. If they purchased a year ago and we put that into effect, Andy, and they're paying it not 6 years less, well, we're saving 5 years.
Yeah, and especially everything's going on right now with the economy. I haven't spoke to a client that I've called them and said, hey, it's time to refinance. No, I don't want to. No. I'll wait for the rates to go lower. Wow. Like everybody's like, I'll take anything right now. If it's $300, $400, that's money that can be utilized and dispersed elsewhere for their lives right now with everything being so high in cost that for them, any ease that they get from their payments or they're able to save money, to them it's good. And they're like, hey, and then when can I do it again?
Yeah. We're doing FHA streamlines too. And you can't, the client cannot cover any closing costs, so we credit that back for them.
Yeah, exactly.
Make it simplify the process so they can we're setting them up for success.
That's an important part. Let's give that the credit that it's deserved in that moment, because the FHA Streamline, they cannot come out of pocket with any closing costs for the refinance of the FHA Streamline, right?
No, it's not they can come out of pocket. They can come out of pocket. The thing is, you cannot add it to their loan amount.
You can't add to their loan amount.
You can't finance it.
You can't roll it in.
Finance it, correct? Like a VA or a conventional loan, those are things you can do. But when you're doing an FHA Streamline, that is something you cannot do.
Right, but the business solution, though, and this is what I'll make the point, the business solution is having a lender credit for those things so that you can still close the deal, get a lower rate, and then save money.
That's correct.
That's my takeaway.
Yeah. Exactly. Mainly, we get the client to come up with their payment a little higher than their payment to make sure that they're recovering everything.
Yeah.
But their loan amount doesn't increase, which is great about it.
That's awesome.
So I can imagine how many thousands of examples like this there are in this 118% increase from year over year same week 1 year ago. Number that's being reported here, because that's evidence of this. Whether it's just to save money on the monthly payment because of the IRRRL or the Streamline. FHA Streamline, or it's cash out and all that kind of stuff. Clearly, there's been a market response by homeowners, and we're seeing that broadly, not just here.
Correct.
What I find that's just super surprising and alarming is that just with the Fed saying, hey, we're going to bring rates down or possibly bring rates down, we're up 118%. So you can take it that whenever the Fed says, hey, rates are officially going to be coming down, what's that number going to look like when everybody actually hears rates are down, rates are down, rates are down? Even though we know the market will price it in, beforehand, but that number is going to go out the roof because of all the people that are just waiting for them to hear the rates just drop boom. And this is just on the hype that it's going to get brought down.
Brian always said Uncle Powell is the most influential man in the world, bro.
Christ, he speaks and the markets listen.
Exactly.
I think there's going to be more of this coming in the fall. Again, I think this is just a prelude to what's to come. We haven't finished this specific week yet, but when this week is all closed, out as far as the business is concerned, I know we're going to have more open escrows because I kind of overhear you guys talking to more people, and they're sending the paperwork in, you're sending the links out to upload their documents to the portal. Like, I just know what's happening, so we'll have to come back to this one full circle next show.
Here's another thing that a lot of times we don't see in all of this, right? This is great information. The thing is, our market is so volatile. It changes so quickly because of everything that we got going on around the world, right?
Yeah.
I mean, last week we saw consumer spending was stronger than expected.
Yeah.
So what people are saying is, hey, I'm still getting paid my 9-to-5 job, and I still have enough money to go buy whatever I need to buy, and overspend. Right? And so the government now is probably teeter-totting whether or not if they're going to even cut rates in September because of that.
Because some of that's necessities. Like, there's just necessities built into that. And I'm not saying like retail sales, all necessities, but there's things like I need retail-wise, I need to buy clothes for my kids. And some of that is attributed to back to school. But again, we have the same back to school data from August of last year and August of the year before. So if we're going to claim that there's a back to school bump, it might just be that. But there's also the necessities of daily living that people have to have.
But that's not how they're portraying this to be. You know what I mean? So here I go. Not that I'm rebuttaling this, but it's just like, it's just unfair, right? Because now, first they got us all excited. The market picked up on that. Now consumer spending's higher. Now it's retracting from that.
Yeah.
And so now we're all in a pause and a standstill to see, well, what's going to happen tomorrow?
Yeah.
Because it's that volatile.
They're trapped.
Like, it's what it is.
So day by day.
Still,
day by day. Thank you. Welcome to our
the Fed's still trapped.
Industry.
Welcome to episode 82. Guess what? The Fed's still stuck.
Yeah.
Haven't we been waiting on the Fed for how long now?
Oh my gosh, we've been waiting on the Fed since like 2019.
But what I do like about this is, it's bringing relief to people. It's bringing them hope.
Yeah.
People who are really struggling, even that $1,200, listen,
That's
they make great
money.
income, but they still can use that additional income. They were so happy when they're going to skip the 2 months and they're going to get their escrow. They were like, bro, that's going to allow us to do it. And I'm like, you guys make an excellent income.
And it's right around it's right around this time of the year. We're turning into fall. People are starting to get their eyes towards their fall activities and,
Halloween.
The holidays. And I'm telling you, even Brian's, bringing up people saving $300 or $400 a month. That's a lot of money, man. That's not like we can't just like throw $300 and be like, oh, whatever.
Well, depending on what their income is, $300, $400 could be a lot of that. Extra bills to be paid or groceries and stuff. So that can go a long
And then
way
you got the 2 months, Brian. So if your average mortgage payment right now in San Diego is $36,000 to $4,000, that puts another $8,000 in your pocket to go do some of these things, pay off one of those credit cards. In addition to that, you start saving $300 to $400 a month.
Yeah,
that's not bad. Yeah. And some people would then understand if you even have that money, throw it back to your principal. It's like you got a free refi.
Yeah.
So it just depends how you look at it.
Yeah, good point.
What you do with that.
And I'm glad you brought up the mortgage accelerator calculator. I know that's something it's not necessarily unique to us, but it kind of is unique to us because I don't actually know a lot of other people talk about this on how to use that same monthly payment but apply it towards your principal balance and pay it off early. We're actually showing people how to pay out your loan off early. That's
correct. I'm not the owner of the bank. I want you to go and pay off your property, right? Go and invest in yourself.
I don't know that bank.
I don't own the bank.
I'm not the owner.
Next episode, we own a bank. No, just kidding. Well, let's continue, guys. We're going to talk about mortgage rates again, but not in a different sense. So this is mortgage moves to make before the Fed starts cutting. Now, this is coming from CBS, and the whole point here is to get yourself prepared for what's to come. Now, when the Fed started to increase rates, there was some talk about, hey, what you should be aware of, what you should be alert and know about. And now it's kind of the converse. And it's like, hey, if the Fed's going to start reducing rates, here's some things you should be aware of like right away, more preparatory than it was when they were on the way up. The number one thing they mention here is knowing your mortgage rate. So in case you don't know your mortgage rate, you have something called your mortgage note. Your mortgage note will have all the terms and conditions of your loan, including your mortgage rate on it.
And I believe you get it every month, either through your email or in the mailbox.
Well, so that's your bill. Yes, your bill's going to come every month in your inbox or your mail. Your mortgage note's going to be with your loan docs.
That's correct.
That's a really important document, and you're going to have your mortgage note rate on there. So number one, know your mortgage rate. Any other comments about that, guys? Like, that seems pretty simple, right?
Yeah. Duh. You should. I mean, you sign that, you find a loan document. It tells you what your note rate, what your P&I, principal, and interest payment's going to be.
Yeah. So if you don't know where to look, go look for a mortgage note. Number 2, determine what rate drop might make refinancing attractive. So this is what I want to call your strike point. Your strike point is when I see blank, I will blank. So when I see a 0.5% drop, I will call and ask a question. When I see an entire % drop, I will submit an application and get all my paperwork in, whatever. Predetermine for yourself what move you might make when X happens, you do Y.
I like that plan.
Yeah.
No, it's simple. Like, I mean, you could find a mortgage calculator online, play around with the numbers, and then verify with the local mortgage lender or somebody you trust. But it's that easy. You don't have to call anybody to get started. You just have to play around with the numbers and then just verify that, make sure everything's good.
Yeah.
That's right. I mean, what did Elon Musk, what are his 3 Ps?
Prepare,
plan, prepare.
No,
It's PPD.
It was
PPP.
It wasn't Elon Musk. I don't think it was Elon Musk. I think it was Patrick David, wasn't it?
No,
was
but
it?
Elon
Does he have
Musk.
it too?
No, it's Elon that actually he goes about the 3 Ps.
Okay, now we're all sideways.
Right.
Which 3 Ps are we talking? Does he have 3 Ps too?
He's saying to plan, prepare, and persevere.
Okay, what's
When things are-
PPDs?
Predict, prepare, persevere.
Oh, there you go.
Predict,
So somebody's copying each other.
So we'll get back to you guys on that
We'll get
one.
you on that one.
These are the 6 Ps. 4 of them are the same word.
That's how important they are.
Hey, we're gonna have to like bake that one in the description.
But I like it. It just makes perfect sense. If you're looking at that sense, you're already planning, you're already understanding. An understanding of what you're going to do if you get this is very important.
Yeah. Well, it's coming. I mean, I think that's kind of the takeaway is they're not just telegraphing the move.
Yeah.
Like something has to happen, whether it is in September or it's not now, whether they do or don't. Okay, that's fine. They're going to kick the can down the road and it's going to be in like the November meeting or whatever. Then it's going to happen then too. I don't see a situation where they are where they're not cutting a rate at all this year. Yeah. So the idea here is to prepare now because there's a lot of things you could benefit from. I know in the last segment we talked about just much monthly savings, but there's some other things I wrote down here that if you prepare for, you could alleviate your financial situation. Number 1, taking your mortgage insurance off. If you have the ability to refinance because your property value has increased so much and you have enough equity to get your mortgage insurance, refinance, and then get rid of your mortgage insurance, that'll save you a couple $100 a month.
But here's another one, Andy. A lot of people think they need to refinance to get that mortgage insurance. But what people don't know that if you made 24 consecutive payments and you can prove with an appraisal, either a BPO, which is a broker price opinion, or an appraisal, the bank your mortgage company will give you those options.
Yes.
If you can prove to them that you have more than 20% equity, they'll remove it without you having to refinance.
I'm glad you said that. It's important really that you prove it. You can't just email them and tell them, hey, I looked on Zillow and it says this.
Yeah.
No,
so you said a borrower?
Yeah.
Homeowner.
So the homeowner.
Yeah.
Yeah, that's the good thing about it. Just call. If you have mortgage insurance with FHA, that's not the case.
Yeah,
correct.
Okay. Conventional, it is, and we already know with USDA and VA, they just don't have PMI.
Right. The FHA one is 78% of the starting loan balance has to be paid off. It's not an appraisal.
Exactly.
And actually, just going back to what you said earlier in the podcast, many people think that rate must drop 1 full % to justify refinancing, which is a misconception.
Yeah,
the benefit isn't necessarily tied down to a specific percentage drop. Although larger loan sizes could potentially benefit from a smaller rate drop, while smaller loan sizes would need a larger rate drop. But it's not like, hey, half a percentage of mine I do. Run the numbers.
Exactly. And here's what's cool about it. With VA, you have this protection. You have a recoup period, right? If you can't recuperate your closing costs within 36 months, the VA will not allow you to even touch that thing.
Yeah.
So it's got to make sense.
Yeah.
I remember before some lenders, they refinance even with the quarter. Hey, they're saving $80 and it worked.
Yeah.
But that was what people wanted to save, right?
Yeah.
So, but now those numbers
sense.
are just non-existent, not here in California.
Those are the things I love about the VA loan, though, is because it has these safeguards in place for the homeowner. That's one of them, the recoup period, where whatever the cost is of doing your refinance, you must recuperate by virtue of savings in the first 36 months, and your monthly payment has to reduce by 5% or more.
Exactly.
So that I love that because it helps prevent some unscrupulous lending and marketing practices that might just yank someone into a refi to just make money for the bank or lender and then not benefit the homeowner at all. I'm really happy about that. Real quick before we go to the next part of this article is I also wrote down here preparing to pay off debts and preparing to stash cash. I've heard both of you guys talk about this where people are paying off consumer debts that they accumulated, whether it's by their own hand or situations they had to pay for things they weren't expecting, unexpected costs of their life, and then just saving some money for a rainy day. As part of that cash out. We're going to do this all right now, then I might as well also do this. I'm going to sit on 50 grand, 60 grand, and just let that ride. So,
I mean, hey, I'm laughing right now because we're the worst country to save.
I know. It's evidenced by the deals that are coming in. That's just the way it is.
Yeah.
And I know that the behavior is behind that.
Yeah.
But also, I'm not going to just say it's the behavior, guys. That's not really fair. I'm sorry. That's not fair to our borrowers.
Yeah, be fair.
It's also conditions. Like there's certain things that happen that you cannot prepare for.
Correct.
Too, yeah.
And, and I'm going to say this, not to like point a finger at the insurance industry, but there's broadly a lot of things that insurance isn't going to cover right now. And they're not going to give you the $20,000 in your policy that you think you're going to get to repair the damage for over here, and it's not going to happen.
Yeah.
So I know very personally of a situation where it was $14,000 out of pocket to fix expenses because there was an insurance rider that specifically excluded a particular type of damage in the property.
Dang, that's crazy.
So there's 14 grand right there. Now, if you don't have that 14 grand, what are you going to do?
Oh, yeah, no, absolutely.
Right? And that's the thing one of the issues that some people are like, oh, I'm never going to refinance. But if you're in the situation where that's your only option, like that's your golden ticket to get out of whatever obstacle you're in.
I mean, here's the thing, guys. You're sending all this equity. It's great to have it in there. But then you look at your bank account, there's nothing there. What's the meaning of it? You might as well have something, go leverage it, go put in freaking, right now, treasury bonds paying 5%, like go earn
6
some
months,
interest on this. Like, and especially if your mortgage is in the 2, 3s, like, go do something.
I had a client that brought up a good point to me. He's like, hey, when you escrow your property taxes and insurance, he's like, I don't want to do any of that because I don't feel comfortable my money sitting in an account for free doing nothing at all. So he's like, I'm gonna take that money and go invest in myself, and I'll pay my property taxes. Like he's like, it's cool. He's like, to me that doesn't make sense. He's like, my money's literally just sitting for free in an account.
Exactly.
So I was like,
and that's true.
I'm
well,
like, oh shoot.
Hey, it's free for him not making anything.
No, but the bank, they got plenty of escrow accounts that's just side cash parked right there.
And that's why there's also a rule behind that you cannot escrow so much at a certain point in time.
Makes sense.
Because then who plays with that money? Obviously not the consumer.
Yeah, they're just ingratiating themselves at that point.
That's it. And here's the other things too that I've been seeing happen with homeowners insurance and the taxes, right? A lot of times the bank isn't paying the home insurance.
Oh yes, I heard about that.
Yes, I've been seeing them
they're not paying the renewal.
And
then the
they just let it write.
And that's a contract that you have. So if you're escrowed account, you need to communicate with your mortgage company. And if they don't make that payment, and a lot of times they drop you just because of that, and on to the next, because we don't want to insure people, right? We're having a big issue with that.
Yeah, it's still your.
And the reinsurance is another.
That's a really important point. It is still your insurance, even though your escrow fund is making the payment for your policy premium for annual or biannually or monthly, whatever. It's still yours to keep intact. So let's not like sidestep the responsibility we have as homeowners to make sure that our insurance policy is in place.
Yeah, exactly.
That's a great point. You know what? I'm glad you brought that up. I didn't think about that.
Either.
Yeah, contact your lender. Like if you know more or less when it's going to need to be renewed, just make sure you contact the mortgage company and make sure that they're making that payment so they don't drop you, because they're just dropping right now clients like flies, bro. It's crazy.
Last thing on here for this article, guys, was just map out your upcoming big expenses. So if you know you have something coming up in your life, a life event or a change you need to make, when the market rate and the market environment rates decrease, know what you're planning for. Yeah. And it kind of goes with the other one, like, prepare in advance, but really just be strategic about it. Like if you're going to make big adjustments to your house or make big changes or upgrades or all that, like be prepared and be tactical. Be smart about it, I guess is my big takeaway.
I like this.
Be smart about it.
Strategize for sure.
Yep.
Strategize.
Okay.
That was 3 P's, all right.
So 3 T's.
The six P's from PBD and Elon Musk. So this next article, guys, is from CNBC. Equity is not like bread, an expert says. It won't go stale. Bread. So this is a bread in a house. Mice live in bread houses, don't they? Yeah. So
gingerbread man.
Equity won't go stale, and then here's when it makes sense to tap that equity. So right away, top line of the article: homeowners are sitting on $17 trillion in equity at the end of the first quarter of 2024, according to CoreLogic. My nerd friends at CoreLogic, I love you guys. 17 trillion. 17 trillion. Yeah. Remember how we were talking about how the consumer debt, like total consumer credit card balance, like 1.2 trillion or something?
Everybody just cashed out.
That would still leave us with 15.8 trillion of equity. If we use home equity to pay all that off. Can we just refinance everybody right now? We'll just take some equity. And
just write a $17 trillion loan.
That sounds like a great socialist policy right there.
That's awesome. That's crazy.
Nobody's going to pay credit card debt anymore.
Now, so here's the point. They're saying most people, there's no need to touch that money. Home equity can be. They say it is a less expensive borrowing option. I'm not on that train that it is like definitively. It can be a less expensive option. It depends on the whole picture. It's not just one thing. It is comparatively to like personal loans or like credit cards. Like if you need $50,000 or whatever, use the HELOC, not the credit card, because credit cards can be 20% or 30%.
Could be.
Crazy like that.
Yeah.
They have definitely higher borrowing rate. But we talked about home equity a lot here, guys. Has anything changed with mortgage rates going down that has caused people to maybe consider refinancing versus doing equity line of credit?
Oh, yeah. We have plenty of VAs right now. I mean, obviously, Mortgage Heroes, we represent a lot of veterans, right? And so the way they look at it is, let me take the money out now because I already know there's a VA early on the horizon. Yeah. And after 8 months or 210 days after making your first payment from your refinance or your purchase, that's when you're eligible to, use your VA IRRRL benefits.
So are you seeing people, so just clear, so I'm clear, you're seeing less people ask about HELOCs right now?
Less.
Okay.
Yes.
So I ran into the scenario where a client wanted to do a HELOC versus a cash out refinance, and we broke it down and I asked, well, at the end of the term of your HELOC, which is 20 years amortized over 30, meaning you have to pay it back in 20, but you're making payments at 30 years. What's your strategy to pay it back?
Refinance.
Okay, and I asked him, I was like, so if we did that exact same thing right now, took out that cash, you wouldn't have to pay anything back. You would actually then 6 months, 8 months later, refinance again and actually then either drop your payment even lower
that makes
and
sense.
You kept everything in your house. And he's like, oh, well, my financial advisor advised me not to go with the cash out refinance and to take the HELOC out. So point being is I put numbers next to them and said, well, which one makes sense? Which one are you always going to pay? Your house. Which are you going to have $56,000 at the end of your 20 years to pay it all back in a lump sum? No, but I bet you're going to refinance it down the line. And he kind of didn't take it well, but down the line, he's like, well, that makes a lot more sense. He's like, financially, I know they say don't refinance my property, but in my situation, I'm not going to have $20,000 down the line to basically, $50,000 down the line to pay a big lump sum and a balloon payment. Yeah. Wow. So I'm like,
and here's the thing with all of that, Brian, what a lot of times people don't understand in our industry, there is what's called a blended rate.
Yeah.
So it's like you get a 10% HELOC or whatever, HELoan, and then you have a rate of 3.25, like, your blended rate, Andy, you're good at math.
Between what number and what number?
10 and 3.25, say.
Depends on how much is weighted on each loan balance. If you have a loan balance of $500,000 on the first 3%, and then it's $100,000 at 10, it's a ratio, right? So it's not just 3 plus 10 divided by 2. Yeah. So it's proportionate. So it's okay. I'm not trying to dodge your question, but
no, because that's right? Like you could borrow $50,000, you could borrow $100,000. Some people have a person that wants $250,000.
Right.
Well, that makes no sense to do a line of credit. It's just the blended rate's going to work out much better. And I'm glad that you brought that point up. It's going to work out much better if we just do a full cash out.
Right. Because a lot of times, when we're having a HELOC conversation with somebody, they already have a really high balance loan on their first. Yeah. It's $500,000. It's not like they have a $100,000 first and they're asking for a $100,000 HELOC. They owe $500 on the first and they're asking for 50 or 100 or 200. So then proportionately, you're like, oh, well, this is the large bulk of my payment is still connected to that $500,000 first. Yeah. So the blend of those two things is going to be a proportionate of proportionate value. I'm only saying that so that people watching aren't thinking like, oh, you just add them up and divide by 2. Like, no, not that simple unless they're both equal value. But
and here's the other thing going through this, the 17 trillion. Right now that we're talking about all these people that have a ton of equity in there. Like when we're running credits and stuff, we're seeing that they have 100 to 150,000 just in credit card debt.
I know, that's crazy.
That's what I was going to bring up as well. That once these clients try to, get a HELOC, they're going to run into the obstacle that the bank's going to know that you're cashed out on all your credit cards, and that's going to be even harder to get approved because of the fact that they go solely based off your credit.
Yep.
Whereas with the cash out refinance, you have a lot more leeway to be able to hold higher debt, and you can hold your debt and use that cash out to pay it within the transaction and basically keep the rest after you paid everything through escrow.
Yeah, you really got to know what you're doing if you're going to do the HELOC versus the cash out.
I think that the HELOC is a good option with a low loan amount to somebody that knows that they can pay it off quick, like, hey, I know that I'm going to have money coming down the line, or something that you could really easily replenish it. But once you're talking about, hey, I'm going to utilize it for Xing out debt, you're really just moving it to another place that down the line still needs to get paid somewhere or another.
Yeah.
I wrote 2 notes here I wanted to bring up to you guys just kind of to round this out, because the article's contending that remodeling can add value, but I have like a massive asterisk to this thing. So you have to be careful here, because it's not always dollar for dollar. First of all, you might be trying to add a $50,000 pool. That's not going to add $50,000 to your house value.
I've heard about that.
Okay, so real quick, I wrote.
Where do you find a pool for $50,000 now?
I'm just trying to use
it was $100,000. They told me, but
that's a good example. Thanks for bringing us to 2020. To 2000.
Well, hey, by the way. No, that was not.
Hey, he was upset at that one. He's like, "Yo, where?
Yeah, where?
Like, I would have had like 3 of them already."
By the way, not so much of a slip in 2020. It wasn't actually $100,000. It was that's how crappy.
2000.
No, I know. No. Listen to what I'm saying. Back in 2020, things were not as expensive as they are now. I'm making an inflation point on top of your point.
Well, yeah, dang inflation.
We'll see you guys next week.
So check this out. So two areas I wanted to focus on. So if you're looking to add value, you have to. I'd say if your house is old and you need to modernize it, then you might be only getting up to what the current value is. So just take that note. If your house is, let's say, 30 years without having any sort of like modernization, you putting a bunch of money into it might be just getting to where the rest of the neighborhood is at. Number 1. Number 2, increasing living space and square footage can add additional square footage, which then the price per square foot by having more mathematically will raise the value of your price. Please do not think that by adding a new countertop and cabinets and all that, you're just going to automatically go from $500,000 house to $1 million house. That's not how it works.
But Andy,
there's
put
too many.
$100,000.
No. Here's why I'm saying this. There's way too many shows. I watch HGTV.
That's what I was gonna get
I'm
at.
seeing all this stuff online. And I'm like, it's Bob and Melissa took $20,000 and put new tile and carpet, and like now their house is $150,000. Like, no, it didn't.
And their income's only $50K combined.
Yeah, like that ain't happening. No, not the buyers. Not the buyers. That's crazy. I'm talking about people do like those home upgrades, and you're like, they listen, that faucet's $300 at Home Depot. That ain't no $10,000 upgrade.
Here's the other thing, that they're doing it to their liking.
Yes.
Not everybody likes that.
That's true as well.
And that's why you get so many buyers coming in through the property, and not everybody's putting an offer in.
Yeah, that's true.
Yeah, because you could think, oh my God, I love that I did this house so perfectly. Someone's like, ew, why would they do that?
Yeah, and I only mention that because it says remodeling may add value, and I 100% agree. It might. It just there's situations to that, so I don't want to get I don't want to just jump on and be like, oh yeah, of course. Well, you make remodels, it automatically makes your house
it's always a good
more.
idea. Like if you're gonna sell your property because you got orders, go somewhere else, or you just need to do a step up in basis because your family's growing.
Yeah,
and the property needs some TLC. It's good to paint neutral colors, and the great thing is you can always go to online, YouTube, whatever, and what are the trending colors right now going, neutral trending colors, right? And then you get some ideas, and don't break the piggy bank for that. Just make sure that you do something to make it where the new buyer is going to go into and say, like, I don't have to put that much into it.
That's it. I know we've had numerous situations where someone maybe did a short-term HELOC because they were looking to sell their house.
Yeah.
Like, in 6 or 12 months, I'm going to sell this place, so I'm going to use the equity to pay for the house to clean up the yard, fix it up, paint the face of the house, and do all that stuff inside, interior, and then actually they recuperate all that money by right-sizing their value in the house compared to the neighborhood.
Yeah, and here's and I love that it says 17 trillion. This will all change. It could decrease.
Oh, sure.
Right now, if we look at last year's numbers, we have 693,000 homes available nationwide. Mm-hmm. When we first started the year, we were like at 300 and change.
Yeah, it was small.
Well, because of the higher interest rate, that's been allowing the inventory of housing to grow.
Yeah. Mm-hmm.
Even with the reduction of the interest rates, buyers still were on the fence. Mm-hmm. They were like, I may want to wait till after elections. I may want to wait until the rates go down. So we're going to put a pause. So we haven't seen a huge uptick on buyer demand.
And that's what
that'll also affect this equity of 17 trillion.
Mm-hmm.
I was curious to say, I wonder if we're going to have a hot winter month after, we have rates coming up that's supposed to be dropped in September, elections in November. And then how's that fourth quarter going to play out once we know rates are dropped and then we know who's taking over the presidency?
Yeah.
Dude. What's that going to do for the market? Because there's a lot of people that are waiting, like you were saying before, I'm waiting for my guy to get in. And once their guy gets in, they're going to start acting. And that's just to add on to the people that are just jumping every day when they get lower and lower and lower for their tier.
Or my girl.
Yeah.
She's going to give us a $25,000 home buyer credit, right?
Did you see that?
No, she's not. You already live here.
So exactly. they asked her, and they asked, I want to say they asked one of her team members or something like that, and they're like, would you say that this would increase housing prices and, just make things like, worse? Don't quote me, but it was something along the lines like that. And she's like, yeah, that could be something that could happen due to the fact that we give this credit. Like, throw a wrench in there and just make it even worse? God, come on, guys.
More unintended consequences ahead.
It sounds good for people that don't understand what's really going on. Like,
well, that's going to lead us to what is actually a problem currently happening in the market that particular option will not offset, and this is that a couple who earns $250,000 a year says they can't find a house within their budget. This is from Zero Hedge, so economics in here a lot. You guys. What do we do about this? We talked a couple of shows ago about 237 cities having starter homes at the $1 million mark or more. And now we're getting an article here that says $250,000 is not enough for this couple to find a home in their budget.
But I did read that they were looking for the last 3 years. And then I did a little research and went back to 2021 when rates were around average 2.7 to 3.1. And I'm like, well, what are you looking for then? Because they want a $3,500 to $3,500 payment, and I'm like, well, back then it was a lot easier to get than it is now, and you're probably gonna have to wait another 2 years to even come close to that. So I was just kind of like, way to just shoot yourself in the foot.
Yeah.
So I know I picked this one.
It's what you call on the fence way too long.
I saw the 3 years. I'm like, well,
So I picked this one so we could talk about it, guys, because there's a lot of factors here. So I don't want to just read through it. But Brian, it's a great point in bringing that up, because people that waited now might have waited too long, and the choice is now painful. So can they still afford a home? Probably, but they're saying in their budget. And I want to highlight this part. Now, they're saying, we wanted to spend $3,000 to $3,500 a month at 30% of our take home after taxes. Well, again, that's take home after taxes, not 50% of gross. Correct. So you have all these like math things at play. If they wanted to get a house for $10,000 a month, they could, but it doesn't meet their budget. And that's just the way it is. So in some cases, I'm not saying that you can't have a house if you don't make $10,000 a month. I'm not saying that, or pay $10,000 a month. My point is that our own personal decisions cause some of these outcomes. This is not just point and blame the market, point and blame the Fed, point and blame the industry, point and blame sellers and all that kind of stuff. Sometimes it's just not in the cards, and it doesn't work out for you because sometimes we wait too long. Yeah.
No, and it's true. Like, this is the case where you're kind of being unrealistic. $3,000 to $3,500. I mean, BlackRock came and bought over 5,600 units in San Diego.
Yeah.
And in the last 3 years, the rents have increased by more than 38%. They went from $1,600 to $2,600 on average. Mm-hmm. So is that going to be us? Is that going to be you, the renter? Because you're trying to be on the fence and just seeing what's going to happen. Obviously, they missed the boat.
Yeah.
They missed the boat. I mean, like they say, Jesus right there, you got a 2.7
rate.
I want to see a sign that this is the right time, right?
2.7, 2.7, 2.7.
And you don't take advantage of that when you don't see the light on that one? No, I'll wait for the rate to go down. It didn't happen, guys.
So on the other side, let me take the flip side of this. Like, yes, they might have missed the sign, might have made the wrong choice in waiting, but now how many people are in the same situation?
Too many.
There's so many people we talk about, because we've talked about affordability until we're blue in the face. All my hair's gone.
The worst ever.
I had hair when we started talking about affordability and inflation. Now
82 episodes ago.
82 episodes.
Yeah.
So, but I mean, how many people are in this situation? They're making I would say good money. And I was having this conversation with my wife this weekend, and I was like, I was just talking about like us. Yeah. I was like, we do really well, but it takes a lot more now to do really well.
Goodness,
number one. And doing really well used to yield different things.
Yeah.
Like, we used to do different things that we're doing now with the same amount of money that we're making now compared to before.
Exactly.
And it's like, it's just this erosion. And it's not just us, of course. I know it's not just us. It's not just the folks in this article.
It used to be, Andy, when I used to see clients that made $80,000, $90,000, for sure they're getting in.
Oh, yeah.
For sure.
Yeah.
I have a client that yesterday I had to have a hard talk with her. And she works for Homeland. She's been there 3 years. She makes about $115K a year. And I couldn't get her into our property at $475.
What?
One,
Wait, what?
You can't find anything. Yeah. Her max was $475, okay, with no
man.
HOA. And that price point here in San Diego won't get you even. It's not going to get you anything. You know? So it was her credit scores were like a 748, good credit. She had a little bit of money saved up and stuff, but it's like, no.
Dude, that's tragic. That makes me so sad.
It's not going to
See,
happen.
that specific case for people that are like, well, I have everything compensating that I'm supposed to. I've been working hard. I'm doing this. I got money in the bank. Like, that's unfortunate because they're like, I did everything right. And then now I'm like,
yeah. Now I need a second income, right? Now you're doing second income. And for us to use that, you'd have to, with VA, it's 2 years, 1 year with conventional, you know, you can do that. And so it's like, you just have to wait now.
Yeah.
Or find a co-signer.
But then that puts you in that waiting room again, just like these folks here in the article. It's like, now I'm waiting. Is the market going to continue racing out ahead of me?
Yeah.
Like, how am I going to catch up to it? If it's ahead of me now and I got to wait longer, am I going to just be trying to catch up to it again later?
Yeah.
Is it ever going to, am I going to close that gap? Am I going to close that gap? I think that's the hardest part in having these conversations right now with people, but also even with the internet.
Yeah, these are facts. This is what it is. This is what it's been boiling down to.
Yeah,
it's just not Samuel and Laura here at Graves that's going through this. This is all, a lot of the people, the majority of our nation that's facing the situation right now.
Well, and I'd say especially in these areas where the 237 cities that have $1 million starter homes,
that's crazy.
Like. First of all, that's crazy.
Yeah.
Was it half of them you said were in California, I think?
Oh, yeah,
was
exactly.
Half of them were in California? Like, all right, well, here we are. And then, what do you tell someone what do you tell a couple that's bringing in $250,000 and they're like, it's not going to work.
Yeah.
Like, dang, that's a tough conversation.
Yeah.
But I think for their case, they didn't want it to work and it could have worked. But that's just, like, hey, it doesn't work for us right now.
Because $250 is a lot of money.
Yeah, and the market's not going to just go, oh, you want to be in a $3,000 range? Let me just change the market into what you want. Like, no, the market is what it's at. And it's being set by other people who are willing to pay it.
Yeah. Because, Andy, $250 divided by 12, what's that?
You're talking about $25,000 a month.
Okay,
gross.
There you go. Come on. And you can go with VA.
Or 22. Wait, did I do that right?
I don't know.
Whatever. It's like 20,000 and change.
Perfect. So, and then if you're going 45 with, debt to income ratio with conventional, that's a nice substantial. You could afford more than a $3,500 payment.
Yeah. Yeah. It's $20,833 a month.
Okay. And multiply that by 45% debt to income.
Shoot. Come on now.
We're not going to go with the 38 standard that the government wants, or
24.
what is it?
Yeah. Times 45 debt to income ratio. So 9,370.
There you go.
9,375.
Okay.
So that's what the
even
threshold
if you stay
is.
like a 6,000-7,000, you know what I mean? That's going to be doable. You should be able to find a home. That's going to put you in the $800,000 range.
Yeah,
more or less.
I mean this 9,375 is like 3 times what their budget.
Correct, yeah.
What their budget wanted, even though that's the threshold for the debt ratio.
Yeah.
But if we were looking at what would be the qualifying basis on the 250, there's your number.
Yeah,
that makes sense.
93. Woo.
There you go.
Man,
and I'm not saying that you have to go with that. I'm just saying, hey, we'll go double it to 6,000.
Man.
You know,
so
and then
crazy.
start earning equity now.
That's so crazy.
Yeah.
Be a part of the 17 trillion.
So I think maybe the push here is like, hey, listen, if you are making good money and you're trying to figure out where the inroad is, you might need to close that gap a little bit on your approach. The market might do a little bit for you with rates coming down. The market might do a little bit for you with inventory coming back on board. But you might actually have to edge a little bit closer to yourself as well, not just think everything's going to come right to you.
Yeah.
That's, I think, what I would say.
Yeah, not only that, like really be realistic.
Yeah.
Be realistic. I know that a lot of time is like we want all this data, but then having all this data and not really putting it to work is going to do you no good.
That's a very good point.
Yeah.
So, it's like analysis by paralysis.
Yeah, and you would think that they're, from what I see, they're financially responsible with how much they want to spend. So I'm sure you're how do you say, resourceful enough to be able to find the research and information that justifies why it is that you should be buying now or why you shouldn't be buying, and make a logical decision.
Yeah. I mean, if you just stop me on the street and you're like, hey, would you like to pay $10,000 a month for a home? You'd be like, yeah, I don't want to. I don't want to. Like, that's what it takes. Okay, well, maybe later.
Yeah.
There's that. I guess there's that part that it just exists too. So
yeah.
Well, you guys, thank you for another great show. What was your favorite takeaway from today, Memo?
For me, it was the refinances, right? Me that I'm being in the trenches right now, seeing the benefits that the people are taking advantage right now, whether it's going to be 0.75%, 1 full percent, it's making a difference.
Yeah.
And me seeing them how happy and how grateful they are, I'm glad that we're talking about that, because it just brings true meaning of what you're able to do.
Right.
And then if you're talking about being prepared, which brings to that next article, it's like, I think this is just great. People should be doing that. Prepare, put yourself in a better position, be strategic, you know, and we're helping them strategize with those things. It's not like we're, hey, here's your refund, see you later. No, like, let's work it out. Here's your mortgage accelerator calculator.
Yeah.
You know, if it doesn't work out right now, like I got a couple of clients, don't worry about that right now. Let's worry about it on the next time around. Right? Because then you're really in a better position. Not only did I save you $1,200 now, but on the next time around, what if it's $900? Now let's put that $900 and invest it right back in yourselves, in your equity, wherever you want to invest it in. So
good.
That was my favorite part, refinance.
How about you, Brian?
Glad.
I honestly, I liked all of them, but the most one that came up was the millennial one. I think that was very surprising that it was a clear example that, you know, if you wait too long, you could also reap the benefits of, not the benefits, the negatives of, you know, waiting long. So I think that's, you know, pretty alarming. Really just kind of focus in on that. And if you have the opportunity, you know, don't be so tunnel vision onto one thing, because a lot can change. And as you could see, rates are on the way down. So you'll be able to get some easing. Houses, on the other problem, is still something that we're, you know, facing short of. So rates will come down, houses won't. So your price is still going to go up.
I'm glad that you brought that housing. You know, we're always talking about that we're about $2, $3, $4 million homes shortage of homes. They had this financial guy that just analyzed everything. I forgot what his name is, but he was saying we're 20 million homes short.
Oh, probably.
Right?
Probably, based on how we used to live.
Correct.
And how many, like,
because it was
multi-generation.
2.5 million back in 2000.
Yeah. Mm-hmm.
Shortage
That was
of,
a long time ago.
of builds. Yeah, no. So I think that's the biggest thing for me. Just, you know, the rates are going to come down, but watch out for the houses.
Yeah.
Biggest takeaway for me is the amount of people refinancing either to get themselves out of trouble or prepare themselves for something else. I think that when we look back in time and we put the rearview mirror a year or 2 years from now, I think the folks who are doing that are there will be a very few of them that go, oh, I shouldn't have done that. Yeah. Most people, I think, go, you know what? I'm really glad I did that. I know I'm already hearing that. We're definitely experiencing that with people. There will be very few who are going to regret taking advantage of the mortgage rates going down in this little season. That's
it happens. You know, again, I've been in the industry since 2006. We saw when properties were just skyrocketing. And then 2008 happened. And then 2010, I was like, why didn't I take the equity on that?
Right.
You know, we had the condo right in front of Petco.
Yeah.
Park Loft, you know, bought it for $555 and they were giving me $1.4 million. One, I didn't sell, thinking, well, nothing will happen to the housing market. And then pretty much I had to let it go.
Yeah.
Because, you know, I got myself in one of those NAGAM loans and it was going to adjust. And so now my payment went from $3,500 to like $8,000 or $6,500. Well, I can afford it at that time.
Yeah.
It got sold in a short sale at $485. The neighbor ended up buying it, broke it down, and now made a big old loft out of both of them.
Yep.
You know, but at that point in time, shoulda, coulda, woulda, it didn't happen.
Yeah.
So don't be that person.
Yeah.
Yep.
No, it's
Well, thank you guys for another great show. We appreciate you guys bringing all your commentary and also the real world kind of front of the line experience, especially right now with the rates changing. Yeah. I really appreciate that. And thank you all for watching and sharing the show with people you know, love, and trust. We want to make sure people are winning in mortgage and real estate. And so I know we banter a lot here on the show. We talk about, you know, we're goofy and all that. We just know each other a long time and we're comfortable. But at the same time, like, we're really driven to try to help focus people on how they could better their financial life by leveraging their real estate and their mortgages. So if it's you or someone you know and love that needs that kind of advice, please have them reach out to the guys here on the show and let's help them help themselves. And we're going to be announcing coming up very soon that we are adding even more states to our stable of states that we can lend in, so we can help even more of you nationwide, not just here locally in San Diego and California.
Especially if you're PCSing.
Especially if you're PCSing and you're a veteran or active duty military. So lots of fun stuff coming there. So thank you guys for another great show. Thank you all for watching. Remember to subscribe, like the video, and we'll see you again next week.
See ya.